Good morning. Happy Friday, traders and investors. Todd and Ryan, New Age Wealth Advisors. Good morning, Ryan.
Happy Friday and good morning.
What's up, man?
Sun shining over here.
Yeah.
You know, not so much on the markets, I think, so far this morning, but at least the weather's looking good outside my window right now, and trying to make sense of it all, right? I mean, just so much has happened this week, and a lot to discuss. But man, between earnings, between preliminary GDP, inflation numbers came out this morning. I mean, there's just so much to digest and to analyze, and I know you have thoughts on it, but man, what a week.
Yeah, it's been insane. Yeah, it's so much going on, and I think the conversation you and I had yesterday, and sort of the way I looked at it and talked to people who worked with me at my prior business and the trading end and the much more short term end is there's three scenarios I think that you can find yourself in as a trader or even as an active investor. Either the market's out of sync with itself, you're out of sync with the market, or it's a combination of the two. And Bennett gets in there. Audio flash is good. Thank you, brother. Appreciate it. Oh, you guys didn't see that pop up. That's fine. That's good. Let me just get that on a different screen. So yeah, it's and last week too. Actually, it's been a while since we've done one. So the last one, our audio was off, so I'm still kind of working through that. But so back to that last point, and I think this is a time where I think the market. I think it's for me right now. I think it's the second one, which is the market. I think is very out of sync with itself, and I think we kind of recognize that. There's not a lot of follow up and say there's drastic moves that need to be made in our portfolios, but I think the market is really wrestling with the idea of obviously inflation not being transitory. We have the first GDP contraction. You've got Amazon reporting the first quarterly loss in a long period of time. But we also have very strong earnings in some regard too. So you have a contracting economy. Perhaps the consumer is being squeezed with inflation. Supply chain issues continue to be brought up here in these earnings calls. The market just doesn't know where to go, and I think that's okay. It's just for me. I'm okay with the fact that I can't predict the future a couple days, a couple months, or a couple years from now, and of course nobody can. But I think the market is really confused, trying to sort itself out right now.
And just kind of going off of that sort of premise, even when you go back to last year, and I was thinking about this earlier this week, and not that it feels good to be in this sort of downtrend right now and to have the volatility that we're seeing. But if you take a step back and look at the market as a whole, is this a little bit more normalized than what we experienced from mid 2020 through 2021 last year, where it was just this straight line up? No one thought the markets could pull back. Everyone was saying stocks only go up, and to a certain extent, like you get sucked into that period last year, and even for my.
Sorry, say those last two sentences again. I messed up something in the production. Say that again for me. Sorry.
Just as we saw stocks continue to rise last year, right? And as many people jumped into the markets, and whether through Robinhood or the sentiment that stocks only go up, at times last year that did not feel normal, right? Like that was almost scary to a certain extent, because you're like, how far can this go? You're starting to doubt yourself of, should I be more invested? I'll even just sprinkle in a little bit of my own personal story, and we've shared how I'm looking for a home right now. I closed on my house last year that I sold in New York, and we closed on that in June. And I've shared with you, I'm a long-term investor. If I'm working with clients that they need big expenditures within a year or two, I'm telling them steer clear of the markets. You really don't want that money in the markets, because you just don't know what's going to happen. And so, the money that I had for a down payment of a house, I had it sitting in cash. Like I I didn't want to risk it in the markets. But as the year was going through last year, I mean, I was sitting there saying like, what am I doing? What am I missing? Right? Like, the economy was strong, everything was good, but you have huge self-doubt because you're just seeing this massive run up. And that almost felt uncomfortable to an extent because you're like, this can't go on forever. And I think we're seeing that so far year to date. And I don't know when the bottom plays itself out, but this sort of market environment is probably more normal for someone like, you've been trading for 2 decades, you've been in the markets for 2 decades. I've been doing this for, working with clients for over a decade, but in financial services for nearly 2 decades. This is more normalized than what we were seeing last year. And again, it doesn't feel good. Not saying it doesn't justify what we're seeing, but the market needed a pullback at some point.
Yeah.
And we started seeing that. Now we're getting a little bit more probably economic data in earnings reports we'll get into that maybe is supporting some of this volatility. But this is probably more normal than we saw last year. I don't know.
Yeah, we're coming off just unbelievable stimulus, fiscal, monetary stimulus. I just I can't help but think back to that Robinhood. Robinhood reported earnings. I've just been reading a lot of it. It's so symbolic, I think, of the last 2 to 3 year period that you're talking about, which is just a liquidity fueled, again, from both the Fed's point of view in terms of being very dovish, in terms of the government's reaction to COVID, precipitating or causing these unbelievable asset. Some of them are bubbles. We're talking about people paying millions of dollars for pictures of digital monkeys. I'm like, how can this continue? Crypto we can see is clearly correlated to the direction of the market. That's come off. Semis have come off quite handily. We have stocks that have come off quite significantly. So yeah, it's a normal time. And you wrote a great article on the New Age website. I do good job on that. Just talking about the unbelievable volatility and opportunities that are available to us as retail traders. And man, I started trading online with E-Trade when I was like 18 and 19 years old, and it's unbelievable how far it's come. And the retail investors' access to trading markets now, just beyond the stock markets, is we've never seen it before. And now we have other kinds of markets. But the one thing that doesn't change, to your point, where we're coming back to a more normal market, is it's not so much the massive ebbs and flows, because there's always been ebbs and flows in whatever market people are trading, but the psychology that is attendant in reacting to these, whatever market of the day it is, doesn't change. And you and I have been talking a lot about Cathie Wood and ARK and how she's been taking it in the teeth in the media. We're going to talk about that a little bit. And it really just kind of sparked that article. And I know I'm going off script a little bit, but it's really, really important in your behavior, our behavior as professionals. And it's not just putting the blame on the retail or the at-home guy, his behavior that will impact the performance of a portfolio. It spans the entire gamut of the retail guy to the multi-billion-dollar PM portfolio manager who has the same psychological tendencies, that does overreact to all the news that's coming at us. And that's one of the main foundations of our company. That's why we named it New Age, is the speed of information and the availability is unlike anything we've ever seen. And it further, I think, accelerates that human that psychological reaction to all these ebbs and flows of whatever market we're in.
Yeah, you bring up a good point too, and it's not isolated to retail traders.
Right.
You see the same mistakes with institutional funds, institutional
Absolutely.
traders. I mean, and I always tell the story. So historically, we would always go to this conference beginning of the year down in Florida. It was always kind of the jump start. It was end of January. It was the big ETF conference. It was a great conference. I mean, it was wonderful. And you get all the big portfolio managers, economists, you name it, giving their thoughts and everything else. And you could almost always nail it down. If everyone was super bullish on the markets to start the year, you almost could feel yourself saying like, let's pull back a little bit, right? Like let's take some off the table. Let's take a little risk off, because they almost to the T would get it wrong when everyone is feeling the same sentiment. It always happened, and it's not saying that you need to be a contrarian at all times and always go against the grain, but there is something about our human psyche and our human behavior, and these are people that have been doing it for years. And again, economists, some of the smartest people in the world, and they all sort of seem to have that same sort of mentality. And listen, our human behavior, it's evolved over thousands and thousands of years. It's we always talk about having the lizard brain, and sometimes it's hard to get out of the way of our emotions. And we were kind of going through the numbers. I don't know if we have like a chart to show it, but the Robinhood will back it up. Schwab's earnings will back it up in what they've posted. But as we saw, right, everyone was trading the market and buying into it as it was just going on this record pace up. As it's pulled back, you see all the trading numbers, and again, in those are probably more on the retail side, but again, I think you can make the argument retail and institutional. But everyone's pulled back, right? No one's buying, and you see some of the biggest names in our market and economy being off 20, 30, even more on Netflix is down over 70% now. Not saying any of these are an immediate buy or not, but if you're a long-term investor, this is the time to, again, not saying to try to call a bottom and put all your if you're sitting on cash, putting it all to work, but from a long-term behavioral perspective, this is the time when you should be trading. This is the time when you should be getting into the markets, because, like I said, if this money is a long-term money for you, you don't need it in the next couple of years. There's still maybe some volatility, but you got some of the greatest companies in the world right now trading at a major discount. Maybe it's time to put some of that to work, and that is not supported by, again, what Robinhood is showing, what Schwab is showing on their trading revenue. So it's just an interesting dynamic, I think, as you take a step back and you look at it as a whole.
I completely agree. So let's before we get into specifics, let's talk about GDP. So we had a contraction there in GDP. There was a couple things that were going on, and by definition, recession is two quarters of contracting GDP. So we just saw the first, and that's what everybody's been so afraid of, is a recession. Sparked by the inverted yield curve. And of course, all we've talked about over the last 2 weeks, I'm so sick of talking about yield curves. I'm sure you are too. It's all we talk about. Now we're kind of shifting over to earnings a little bit. And the thing that we're saying is okay, where's the right yield curve? 10 to 2, 10 to 3 month, which is more closely tied to federal funds. So we're watching where the Fed is going to go. We have a May meeting coming up. They're more than likely going to go 50 basis points. And then as we look out into future meetings, I can bring up the Fed fund calculator. It's actually pretty interesting. There's talks of 75 basis points at a hike, and I'm looking at some of these long-term forecasts, and even Goldman and some big banks, which, just because to our conversation earlier, just because they're institutional trader, I'm going to go off on a second point here. I've sat in a room with 25 hedge fund traders. I've been in trading floors, institutional trading floors. I know a lot of guys who've traded for large banks on the buy side, I know retail traders who are much better than these guys, even though they sit at a desk. And the second part of that is, I started prop trading right out of college. I was on the West Coast. I started to make my way back from California to the East Coast. I stopped in Chicago, had a good long think about trading on the floor in Chicago, trading either S&P or NASDAQ futures. And I met some of the locals. The locals are the guys who are in there trading their own accounts, making other side of the markets for institutions. Some of these guys are just making millions and millions of dollars a year. And I'll tell you what, they weren't, PhD, quant, MBA, Ivy League guys. They're street thugs from Chicago who are street tough, know they're not the smartest, will take anything the market hands out to them, realizes the markets can be very irrational and fine with it, and they don't have to figure it out. So some of the best traders I met were Chicago street thugs who probably didn't have high IQs. I hope they're not watching this.
they'll probably tell you the same thing. Well, it's all about feel in so many ways. I mean, you look at the markets and you look at what's happened over even the last few years. You could make very rational arguments that we should be priced here, we should be priced there.
Right.
Don't want to be participating in the market at this price point. Don't want to be doing this. Don't want to be doing that. And that's where trying to make it rational, trying to come up with the calculations and the argument as to what a stock or the market as a whole should be doing. You can sometimes get into the biggest. You can make some huge mistakes there. You can miss huge opportunities. You could be chasing at the wrong. There's so many ways to get in trouble that way, and I think we have to understand that, right? That sometimes stocks aren't trading purely on the fundamental basis or a rational basis. I mean, we're all, as we talked earlier, we're all irrational to a certain extent. That's just human nature,
sure.
and the market's going to reflect that, and you got to take that into account.
Yeah, that's for sure, and that's running the portfolios for us. I've grown up as a trader. I spent a good majority of the time on the technicals, but as you're running longer term money, and that's kind of the progression, and I guess we're going way off script on what we wanted to talk about, but I think it's so important here because we're talking about multiple compression from high valuation stocks that ran so far, including companies like Nvidia and the semis and Netflix that are making significant amounts of money, but they're trading at such high multiples. Now we're seeing a change in psychology in the market. Seeing multiple compression and stocks, Netflix off 70% or whatever from the all-time high. We'll talk about that. We're looking at Rivian. I was studying the earnings from Amazon and Ford, and most of their Q1 losses were because of their investments in Rivian. I'm like, what are you doing? Why are you trying to compete with Tesla on this? The psychology has changed. From what's worked over the last couple of years, and that's great. You have to be able to recognize that and stay ahead of it. Go ahead if you want to jump in.
No, I was just going to say, it's a good point, and I think where we're at right now in the market cycle. I think we're talking about pricing fundamentals, even technicals to a certain extent.
Yeah.
Kind of bringing it all together. But you started talking about GDP a little bit earlier, and I think that was of all the
thank you for bringing me back on track.
The macro data that's come out this week. I think that's a big one to kind of jump back in, because you were making really good points as to some of the dynamics of that number yesterday, and especially taking into account where we're at. Coming out of this, I would still say coming out of the recovery from the pandemic, and we talk a lot about as well, and try to talk to clients about this. Like, I don't know what the time frame is going to be to make sense of year over year, data, but it's so hard. I think even still today to make sense of year over year figures and numbers, because there were so many different pockets of time. I think
100%.
Early spring last year was like the first time we were kind of coming out of that hibernation from 2020. And I know different parts of the country were operating differently, but so to go back and try to do anything year over year, I don't know. We may still be a year or two away to really make apples to apples comparisons. But jumping back into GDP numbers, I mean, they were down for the quarter, year over year. But there was some, I think there were some good aspects of that number, and kind of understanding what's really driving the negativity of the recent GDP figures.
The big one, and thanks for bringing me back, and we'll jump into GDP, and just for full disclosure, because that's how I am, man. My wife, she just had minor surgery yesterday, and I hope she can't hear me. But that's fine. I share everything. So she, after I share too much, right? You're just gonna get used to that.
Yeah, let's get into GDP. Let's get into GDP.
No, we gotta tell. So no, it's just no. She's good. She's fine. So I'm momming and dadding over here. So I got the kids off to school. Got my 3-year-old daughter ready to go, and I was administering pain medicine throughout the night. We're good. No, yeah, no, all's well. Hey, that's just part of that's life. So the big thing with GDP was net exports, and there was a big trade balance number that was a little higher than expected. And basically, when the U.S. imports more than it exports, that is a negative impact on GDP. And we're saying the import business was significantly higher, and people are viewing that as a negative. But I say no, because that means supply chain issues are easing, and we're starting to release some of that pent-up demand that we had for overseas business. Okay, and also, if you think about it, the dollar has been ripping higher, and there's been a lot of talk. We've had a couple good discussions. Let me just throw a chart of the dollar over there. If you think about it, if we are doing more import business, that's going to be good with a stronger dollar. It's going to hurt overseas, but if you're buying overseas with a stronger dollar, that's going to be good for us. And also, that's showing that, perhaps consumer domestic demand is not where it's been. The numbers have been somewhat decent, but if you look at the long term here, I think on the dollar, there's a lot of discussions to be had here, and I think that's one of the themes that we've had on this show, and the way we sort of approach the markets. You can't just be a stock market investor without acknowledging and being aware of the other major asset classes, which are fixed income, which is everything we focused on over the last months with yield curve inversion. You have commodities, which very much have been in play. And finally, the fourth link of the global macro flow is the currency market. And the dollar, this is a chart of the US dollar index, has been fairly range bound here through 2015, and here we are 7 years later. Even the most basic technical analyst here can sort of identify the upper ceiling. And basically anything, and this is another thing we'll talk about, is a triple top, triple bottom. Anytime a market tries a certain level for a second time, okay, so we went up here to 103 in the dollar, went up here again in March of 20, interestingly, and here we are now in March of 22 trying to break a triple top. Usually the market will get it. So the dollar's breaking higher, and there's a lot of stuff going on in Japan, which we could talk about if there's an appetite for it here. But basically, the yen is weakening a whole bunch because the Bank of Japan has no ability to raise rates, right? Because they've been suffering from inflation or deflation from such a long period of time. So there's a massive divergence between the two monetary policies of the U.S. Fed and Bank of Japan. And as interest rate policies diverge, that's the heart of the movement of foreign exchange. And the way the dollar is moving, that will have an impact on U.S. corporations, which our large caps are all multinational, so their earnings are being impacted by FX. But again, or you could look on the other side of it and say the U.S. stock market continues to be the only game in town, with exception of some emerging markets that are commodity related. We have seen some good EM moves, but you're not going to Europe. You're not going to China right now, even with the regulation, the increased regulation and more transparency of Chinese companies on U.S. exchanges. So it could be like a 1998 thing, kind of dynamic, where the best game in town was U.S. stocks. So international traders had to sell their domestic currency, buy the dollar to buy U.S. stocks. And I think going back to what you said on the pullback, how much is enough? I think we really got to start to think about that. We just saw the first quarterly contraction in GDP. A recession is 2. Maybe we'll get another one, and maybe recession's over. Everyone was telling us the recession was going to come 18 to 24 months after yield curve inversion. One, we're not even sure if we actually had yield curve inversion, because everyone's focused on the 2-year, 10-year, where it should be the 3-month, 10-year. Plus, as our friend Tom Lee said, on a real basis, if you exclude inflation, the yield curve, regardless if you look at a 3-month or 10-year, 2-year, 10-year, is still normally sloped. So, I am not. We have clients with cash who have instructions with us to deploy when we see it's necessary. We're watching very closely. I'm still watching closely, man. Sorry to throw all that at you.
But digging into the GDP numbers, and I think that's what's really important here too, is when you're looking at what's driving. So we saw the negative reading, or the preliminary negative readings for first quarter, and
Yep.
that's scary on its surface to a certain extent. When you dig a little bit deeper, you got into the import export and how much that plays a role. And there's so much to be said about what we're seeing with the supply chain issues and how that's disrupted both imports and more so for us imports, but just it throws off the balance of our imports exports. The other thing to remember, so the U.S. consumption by individuals like you and
Oh,
me and listeners makes up 68% of our GDP, and
right.
that number was up like 2.7, and so it wasn't up enough to drive the overall GDP number positive, but the consumer is still spending. We're still in line with
Yeah.
what we've seen. We historically the our that new normal over the last 10, 12 years was more in the two, high ones, low two range. Consumption was up 2.7 in the face of all the inflationary numbers and everything else we're seeing. That's a positive, and I think that's a positive takeaway from it right now. And even if by definition we're heading towards or closer, or the chances are higher that we're headed towards a recession, there's still some underlying data that is positive to kind of lean your hat on. I mean, I was looking at recently the cash versus debt was the first time that it went positive. So consumers have more cash than they do debt. First time in like 30 plus years. Now, those numbers can always skew. Maybe that's being driven by more high net worth individuals. So, who really knows it in terms of at which layers those play out in terms of, you know, net worth and income levels. But it's a positive, right? That just the consumer's in a better shape to withstand any sort of this inflation, higher rates, slowing down of the economy. I mean, our jobs numbers have been steady in continuing to rise as we're adding new jobs at the start of this year so far. So there's just a lot of positives that are still out there to kind of like just take a step back and put it all together. I think it's definitely a number not to overreact to right now, but
Yeah.
it's something to be aware of.
I agree. I agree. Well said. So we're open here. Obviously, I always like to kind of look at the market going in here. Just about a half hour in, you sort of let the overnight flows, especially when you have massive earnings coming out. Kind of let them shake out here a little bit. So let's just check to see what was the open. I got to be honest with you. I was concerned when you have Apple reporting, the quarter that they did. They did come out and they talked about some pretty ambiguous future guidance on supply chain concerns. Good numbers. Amazon obviously beat, and futures were down. So I said, today could be ugly. So we were down quite significantly. Futures are down. Nasdaq was down about 1.25 in Globex. Here we are in the cash session open. We're only down 1/3% in the NDX. S&P down 0.5. The RUT is up. The small cap Russell. I got to check in to see what's going on with that. If anybody here knows, I can look at that real quick. Just sort of looking at natural gas continues to go. We're shipping natural gas overseas. There are some plays I'm watching in natural gas that I am looking to add to the portfolio. Gold continues to be worthless. Please don't touch it. Rates kind of hanging around the 3%. The 30-year at 3 to 3.05 is sort of the long-term line in the sand for me. So rates are kind of mixed in here. Here's bonds, copper, emerging markets. FXI up 6.5. Chinese ETF up 6.5%. That's interesting. You look at the chart; it's still very, very ugly. Bonds are down a touch. Ag, U.S. bond ETF coming down to a low. So interesting open here. It'd be very good if the Nasdaq could go positive. After those Apple earnings. If you guys want to talk about that, or do you want to talk about Fed? Tell me what direction you want to go.
I think we should be talking about some of the earnings from this week. I mean, I think
Okay.
I think this week is, from an earnings perspective, I mean, with some of the bigger companies, with Microsoft, Apple, Amazon reporting, I think in Google, that was one I forgot earlier this week.
Yep.
What's kind of been your takeaway, especially given how much these companies make up, the major indices, especially just given their size and growth over the past few years. And when you think back to when COVID first started in early 2020, those companies were almost, recession proof, right? I mean, they got through that much differently than some of the other, companies in areas of the market. But when you see kind of some of the major headlines from earnings this week, I mean, what are some of your major takeaways so far?
So far, it's been a mixed earnings season. I mean, this was the big week. I think, I don't know, 25-30% of the companies in the S&P 500 reported. Obviously, we have most of the big tech out of the way. The numbers have been solid. I think we're finally starting to see the real impacts of the supply chain. We're seeing, I think, brief signs of the consumer starting to scale back in areas where they don't need to be spending money. I think we have a more intelligent consumer post 2008 credit crisis, and I think Netflix is the perfect example. I mean, I think we were sold the whole streaming is going to save everything. You cut the cord, get rid of your cable box. Now we all very quickly realize we're smarter, we're more educated. I think that we're all spending on all these different services, and I think Netflix is a logical choice to save with an inflationary environment. So Netflix, we're out. We did a video about that one. We launched the company in October with a 3% weighting, rebalanced over Thanksgiving, went immediately down to 1%, and then the next one we cut Netflix. It's just the stock isn't working anymore, and it could work, and that's fine in the future, but not right now. Apple was good. You look at the chart of Apple. I kind of can't help but laugh, and this is just a very simple way to look at Apple versus the S&P. It's just a ratio. This ratio is going up on the bottom part. Apple is outperforming the market, and for 2022 on the whole, Apple continues to outperform the market. Where a lot of people have said it's been sort of not dead money, but they've reached max growth. They crushed earnings, $1.52 a share. I think they were looking for $1.43. Sales, $97 billion, $4 billion ahead of estimates. But the big thing that Apple came out and said is just supply constraints. And I think there's every company is going to be citing supply constraints and sort of buying themselves an out for future for Q2 earnings. You see Apple coming back here, $1.60 or $165, $166, just very range bound, but showing relative strength to the market. I love it. And they said they're earmarking between $4 and $8 billion for supply chain concerns next quarter. So that's fine. Stock that took some of the shine off. One thing that I liked about Apple, let me just pull up the earnings, is I liked services continue to grow. Let me see if I can pull this over for you. Services continue to grow, and I like their movement in the Mac. Mac still only makes up, they're only $10 billion of their $97 billion in sales. Mac, with their M1 chip, I think they're gaining market share. They're making a better machine. I think from the PC point of view, I like Mac. iPad was off. I think they had some supply issues there. Their services is continuing to get a pretty good. I think they did about 20 billion net services right there. Services at 19 of their 100, so 20% services, and you can see, we've had some much bigger numbers in the past. 32, 39, we had a big drop, but we're starting to rebuild, hopefully to get back up. And that'll be the key, I think, to Apple going forward, which increases their margins. They're very hardware driven, but they have, a ton of cash, strong balance sheet. And the same thing can be said with Facebook. You look at what Facebook did. I mean, everybody was counting that company out for dead. We put sort of a stop loss in the portfolio. Again, we've been reducing the size of our Facebook position. We have a 1%. And then they came out and they had great earnings. I mean, the bar was very, very, let's say, I read something on Barron's, this is funny. It's like doing the limbo. The bar is like 7 feet over your head, and all they had to do was just walk under it. But, they started to add users back. Their revenue growth is extremely slow, and the big thing is they were looking to lose about $10 billion in their virtual reality labs, which is their whole transition to virtual reality and augmented reality, that whole reality labs. And they only lost about $3 billion, and they actually had revenues that were higher than expected. So that was a big surprise, and I just kind of watched my friends in the media. They've been skewering Zuckerberg for so long, and then all of a sudden he puts a report about like that, and his sort of stock in his own personal brand, I just saw it kind of hit a bottom, and everyone was talking very favorably about him. It was amazing how quickly they did an about face on Facebook and Meta. So their daily active users, they went up to 1.96 billion daily active users. It was ahead of 1.95 expectation. So the users are up. It looks like they're making some progress in virtual reality, the reality lab. So I want to keep it. I want to keep it in the portfolio. Amazon, go ahead, Ben.
That's where I was going to go. I mean, I think that's probably the biggest one, for me this week, and trying to make sense of what's going on there. And you look at, I think that just look, their share price is down 12% to start the day. Have you had a chance to dig into that since last night at all? I know you had a lot of
yeah.
Play.
Yeah, no, it's
any thoughts on that so far?
This was interesting. Amazon, their numbers were they had $7.6 billion loss in Q. Sorry, no. This was they had 3.8. This is where I want to go with this. Amazon quarter is really it's very tricky, and it also the same thing with Ford because of this investment in Rivian. So they had a $3.8 billion loss for the quarter. First quarterly loss in 7 years. We're certainly seeing effects of inflation coming off for their headline retail business. They saw a market slowdown, which I'm not surprised. The stock, Amazon, same thing. Let's do kind of the same thing in Amazon. Okay, this is the same sort of chart, and I'll jump back into the earnings. You look at this thing. Let's just look at Amazon relative to the S&P. That's why it's just such a simple technical indicator, right? Just as Amazon divided by S&P. And if this blue histogram or line is moving lower, Amazon is underperforming the S&P. It's been underperforming the S&P since July of 20. Right? And if you compare that to Apple, Apple's been steadily increasing. This underperformance compared to the broader market, this is just compared to the S&P, has been real for a year and a half. We have we're very underexposed to Amazon, and the growth has just not been there. Amazon has certainly taken a huge part of our lives, but this breakdown here post earnings is not surprising at all. I think it's been sort of in the works for a long period of time.
I think to me, kind of as I think about Amazon and digging into the early pieces of their earnings report, I think for a company like that had such fast, rapid growth once COVID started, this is a company that's kind of still in that phase of it's hard to really understand the full scope of some of the the numbers as you're looking at whether it's estimates or. Because at a certain point, I mean, well, one, they have such market saturation as is. I mean, they're only going to grow so fast and so much for so long. Now, they've expanded. They're in different areas, especially with their cloud-based AWS, and that's been a home run for them. But from the the consumer sales side of things, I mean, that just was rapidly increasing once COVID started, and it's not surprising to see somewhat of a slowdown or not growing at the same pace. Is that more of like where Amazon is in their own business cycle, or is it going to be a little bit of a reflection as to what consumers are willing to spend on, and is it consumers pulling back from a recessionary kind of factor? And I think it's hard to fully understand that right now, but I think that's, for me, that's kind of the big takeaway, is like what's really driving that, and kind of continuing to see that. But I wish the numbers were a little bit better. I mean, it's definitely not a a huge positive, but I don't think we can make like drastic decisions or come away with any sort of major enlightenment from kind of that one-off number, but it's definitely something to, I think, keep an eye on.
Yeah, yeah, and the big thing with, I totally agree. It's, you can't start to say, I've heard for years that the death of the U.S. consumer is imminent, and it just doesn't happen. I think the consumer is getting a little smarter with their balance sheet at home, which is good because that's what we want, right? We want people to be a little more cognizant of the personal finances and not just click on Amazon Prime and just buy whatever you want. Man, weather's easing up on the East Coast. Maybe people are getting outside and not on YouTube and Roblox our kids and shopping Amazon. Maybe people are getting outside doing stuff that they should be doing, which is good. But anyways, no, back to the quarter though. The big one is for them is their investment in Rivian. They had a $7.6 billion loss for the quarter in Rivian. So they reported a $3.8 billion loss. So this is according to Barron's. Excluding the Rivian loss, Amazon's adjusted EPS might have been roughly $7.50. Wall Street however was looking for $8.35 a share. So Amazon has 158 million shares of Rivian. They made a ton, about almost $12 billion in the last quarter because Rivian IPO'd in October of 21. They've delivered less than 1,000 vehicles. I did CNBC talking about this, and people are saying, oh, Rivian and Neo and these other EVs are going to be taking on Tesla. And I made the point that they're fighting a completely different game. And now all of a sudden, they come out and they've got supply chain issues with Rivian. They're expecting 25,000 vehicles next year. Maybe they get it, but they're having order cancellations, are having problems bringing their truck online. Another company that tried to take Tesla on and got slammed. So as a result, Amazon earnings were way off, and also Ford's earnings were way off because of it, because Ford's a big owner in Rivian as well. Ford's a holding in our portfolio. I don't like the pullback. I mean, it's fine. I never like to see pullbacks when we're running money, but this is a stock that I want to continue to hold. I like what I'm seeing with the F-150s. I think those new Broncos are awesome. I want to get one. Ford has pulled back. I think it's trading 7.5 times earnings, or 7 times next year's earnings. The quarter wasn't bad. It's a stock I want to continue to hold. I think they're making right moves and taking market share out of GM. So I'm gonna continue to hold that one. Thoughts on that, Ryan?
Yeah, I mean, it's hard to compete with Tesla. A lot of these upstart, EV car manufacturers, they got to find the market, and I don't think anyone has the not only the supply chain but just the inner workings like a Tesla has, and we're seeing how hard it is to compete with them. So, I don't know. I know they had a lot of fanfare, and they were one of the darling upstarts in that space, but certainly seeing challenges. And it's early though. I mean, a lot of these high growth, high flying companies are going to see a lot of volatility early on in their existence. So, yeah, I think though, as we're kind of coming up to like a 45-minute mark, why don't we just kind of put a cap on like big picture ideas of what we're seeing this week, any sort of things to leave clients, investors with from economic data, the markets. Like what's your big picture kind of feelings right now?
Yeah, unfortunately, I think we're starting to see the Nasdaq slip again, and I see Mac's question there. I definitely want to address that. I do think that earnings are solid, but the markets, the psychology has shifted as we're adjusting to interest rates. The idea that we're going to have 10 hikes this year, and I've had such a hard time, and I've seen this many times before, where the market's certain of something in the future, whatever it is, earnings or some technical development or a Fed's move. They're certain of something, and the market adjusts to it, and then inevitably the story changes, and it doesn't happen. So, I think a lot of people are trading based on the idea, investing that we're going to have 250 basis points of increase in the federal funds rate. And we're seeing quite big moves in all asset classes now. Finally, currencies, as we mentioned, everything's moving: stocks, commodities, currencies, and fixed income. So I would say let's look for peak sort of sentiment, just absolute conviction that we're going to get that much Fed tightening, because the Fed, if we're continuing to have issues like the economy, I think is having, we're starting to show signs of strained consumer. Seeing, I think Japan is a big one that a lot of sort of conspiracy theory publications who like to kind of put that out there, really trying to ring the bell on Japan. I just don't think the Fed is going to be able to hike as much as they think, specifically because the real yields across the curve are not inverted, and some would argue that they never did get inverted. So we have to, I think, prepare ourselves for additional downside. I do think the S&P wants to get below 4,000. It's a big psychological level. I think at NASDAQ 100, 12.5, I would not be surprised. I think we need to sort of position ourselves and be okay with that. But the longer term trend is very much up. I really think this is just a setback from unprecedented times. I think the market is handling it really well. I'm really glad. I do want to touch on this quickly, Ryan, on the Robinhood numbers. Robinhood is I think the stock is kind of tumbling below $10. We can pull that up real quick, and it's just symptomatic of, I think, the whole point that we're making, which is, I think the time of meme stocks, GME and AMC and activist investors, Ryan Cohen and Bed Bath & Beyond, I think we're past that. I did a segment on CBC and said, I just wish meme stocks would go away, and I got flamed on the Reddit boards for it, and that's fine. But you look at this Robinhood stock. It was encouraging people to be in stocks that they should not have been in. People are sitting at home, not working, newfound money that perhaps is from the stimulus or the fact that we're in a bull market, going in the market, and nothing's changed. Like, I was trading the .com bubble on E-Trade, AOL dial-up in 1998, trading high val, new tech stocks. Like, nothing's changed in 24 years or whatever. Nothing's changed. So it's going to bring a new school of investor into the market. I think enough people have been sort of slammed trying to time high valuation. You go check out Ryan's article on New Age with Kathy Woods and ARK. Unbelievable amount of gains that have been made, but a lot of people have lost money just because of the way they've been trading. So just be aware of your own investing psychology as we're going through this pullback. Know what's out there. Know what know what the story is and what people are trying to tell you is driving the market. Kind of take that, say, okay, got it. And that's how I do with the fundamentals. I say, okay, what's the fundamentals? What are being reported? How are people reacting to it? What are they expecting to happen? And more times than not, what everyone expects to happen doesn't happen. And that's how you kind of set yourself aside. And Robinhood is just the latest 1998 tech bubble with meme stocks. We've seen this many times before.
Yeah, I think the big thing with the market is, especially right now, like anyone kind of concerned that we're going to start going towards a bear market because of all this negative news and bad recession numbers or bad quarterly earnings. Well, let's face it, like, we're kind of in a bear market. I mean, you see some of the big, I had you run some of the biggest names, what they're off their all-time highs. I mean, some of the biggest companies, again, Meta or Facebook, Netflix are down over, close to 50% for Facebook, Netflix down over 70%, Microsoft, Apple, Amazon,
I'll pull that
Google
up here.
have all been down 20% or more. I mean, these companies in the markets have been sold off pretty dramatically, to be honest. And so, like, we're kind of in a bear market right now to a certain extent, and maybe not the major indices are all at that 20% number, but the market has sold off, and I think it's a little bit of an anticipation. I know to get to expectations to close out this year, there's going to have to be a lot of growth. I'm not sure we're going to fully get there now. That's for third and fourth quarter, so we still have some time, but obviously, like, inflation and higher interest rates are going to be a major headwind.
Yep.
But the market is always forward looking, and if you're as this goes on, if you're sitting there waiting for some sliver of good news, to get yourself into the market, or if you've been, staying out of the market and you're trying to time a bottom, the market's going to start recovering before we start to get any sort of good news, right? Like that's
100%.
always how the market's going to move. And the market's always forward looking. So if you're kind of waiting for that recession and waiting for all the bad news to be baked into it, like the market's going to start going up before probably the recessions are ever, anyone says we're in a recession. That's typically how it happens. And I think just keeping in mind, like the market has been beaten down pretty good right now. Doesn't mean like we're at bottoms or trying to time this market bottom, but I think taking into account where the consumer is, some of the underlying strength, I always, because it's the easiest two times to compare to, but I always compare to obviously the dot-com crash, and I compare to the global financial crisis. When you look at the dot-com crash, the technology companies of today are much different than the technology companies of yesteryear. Now, there's maybe some similarities into some of the smaller or high-flying companies that came to prominence during COVID, but these are companies that are, for the most part, have strong earnings, are solid companies. And it's
I'm
just
throwing
different...
Teladoc up. Just you're flowing your vibe, but I don't want to throw you up. I'm throwing Teladoc up. Just like here's your tech crash right here.
It's just a different environment. And then when you equate to the global financial crisis, and even some people are kind of pointing to the housing bubble today, or potential housing bubble, whatever your views on it are, as a comparison to the global financial crisis. Well, the global financial crisis was really driven by bad lending practices, underlying weakness, people over leveraging themselves. We're not seeing any of that today. So doesn't mean we can't enter recession, doesn't mean we can't have a pullback. I just think comparing the latest two like major market crashes or major bear markets, we're in just a different space. And like I said, we could have a shallow bear market or a shallow recession, but it doesn't mean it has to go that much dramatically lower from here. And I think there's still a lot of underlying strength, and we'll continue to kind of watch that. And I think that's right now that's my big takeaway from what we're seeing in the markets and what we're seeing in earnings and economic numbers and everything right now.
Yeah. Yep. No. Well said. Well said. I'm just going to let's just adjust a couple of questions here, and then we'll shut it down. Mac, I see your question. I'll jump into that. Serby, this is interesting. Why doesn't Amazon focus on what it does best and stay away from EV investment? Could it essentially partner with Ford if they really want to invest in their EV fleet? Yeah. I mean, I don't. I think they're all looking to sort of do what Elon did with Twitter and sort of get invested, get an inside look, and see if they want to take them on. But
all these big tech companies today are all divested in so many different areas. I mean, it's actually a good thing if you're investing in them, because at least they have some diversification.
Sure.
It's, they're gonna have different streams of income. They don't always, obviously, so far they don't always pan out, but yeah. Yeah. No, tech companies are becoming conglomerates for sure. I mean, there's so many different areas. And I think that's why technology is so important, is because technology is going to increase the efficiency and experience in all aspects of life. So they are trying to diversify. Amazon started as a book company that you would buy CDs and books from online. Look where they are now. I think they do need to. And, I think that's why, stock's off because, they lost $7 billion on their trade, but they also made a lot of money in the last quarter. But Amazon's been underperforming for a year and a half, for 2 years, as I showed it. Then Mac, this is deep. I do have a lot of thoughts on this. He goes, do you think the yuan and yen falling against the dollar, which I think is deflationary, will this end up taking down the inflation rate along with higher rates? So this is very, very complicated. I started trading, my first time trading for a hedge fund was an FX fund during the global financial crisis, the yen carry unwind. And, the yen falling is generally a good thing for global investments. The yen falling real quick means international investors around the world are selling, they're basically borrowing in yen. Okay, so they go to a Japanese bank, borrow yen, at a quarter or 0.5%, take that yen, do an FX transaction, sell that yen, buy American dollar to buy a 5-year U.S. Treasury at 2.904%, right? So you're paying. So the selling of yen is I think a risk-on sign.
You could go and buy a commodity fund in Australia or something and make 8%, and you're borrowing that. So as long as volatility stays somewhat low, I think this yen carry trade will continue to go. They're saying the yen is going to crash, and even zero hedges out there saying, well, the yen is going to be destroyed. Yen's been under pressure and been doing this for a long period of time. Used to be 300 yen to the dollar, got down to 80 or whatever. Now we're back up at whatever, 110, 120, whatever it is. So the yen's got a long way to go to weaken before we're at significantly highs. Is Japan going to step in and try to bail out China? Is China going to step in and try to bail out Japan? Japan, I think, is the third or fourth largest GDP in the world. But the problems that they have are nothing new. There's a much longer discussion, so everyone just seems to be bringing it up right now. But the dollar-yen exchange rate is not anywhere near alarming, problematic, where it's going to have an impact on things. I really don't think so. China didn't get involved in Ukraine. They're not going to try to get in and bail out this because Japan. They're already in economically compromised position. I think China's going to play it pretty close to the vest, and if the last thing I'll say is if they want to step in and try to intervene and provide yen strength, they'll have to sell the yuan. So China will have to sell the yuan to buy yen. If they sell the yuan, which is pegged to the US dollar, that's going to pressure the dollar down, which the dollar down, I think, is creating some of our issues, the strong dollar. So if China sells yuan, they hold a peg or sort of a boundary against the U.S. dollar. It'll press the dollar down, and I think that actually helps us. I think that will help sort of promote some of our multinationals if they went ahead and do that, but I don't think they're going to do it anyway. So it's a deep question, but and I have more thoughts on that. Anyways, NASDAQ kind of slipping away, as I said. I think we need to kind of prepare for lower prices until the market really gets a little bit more dire data. As Ryan said, it's always darkest before dawn, and when we see some real negative data, I think is when we start to look for lows in some of those stocks that you mentioned.
All right.
We'll put a wrap on it.
Let's put a wrap on it. Yeah, I think, and we talked too, this will be interesting. We can talk more about this next week. I wonder at what point, bad news is good news for the market too, because Right. Investor sentiment is so bad right now, and the only thing I can think of is because of the inflation numbers. And if bad news starts creeping in and that slows down the Fed's rate of increasing rates, that could be good for the market.
100%.
I don't want to get into that now, but I think that's something to watch.
I'm just we could go on forever. I'm just looking at the U.S. AAII bullish bear spread.
It's bad.
It's really bad. Hold on, we can't leave them hanging, man. Come on.
Yeah, sentiment's been really bad, and like I said, the only thing I can think of for that is, wages are up, unemployment is down, people are getting hired, people are starting businesses, and the sentiment's really awful.
This is the lowest sentiment. So this is the top.
I think it's inflation related.
Yeah. The top one is percent of bullish investors. So it's 16%. Percent bearish investors, 59%. And then the spread, bull bear spread, is minus 42.92%, which is going to be the lowest in.
I think it goes back almost 20 years. It's the only time it's been lower was during .com and
so this was
at global financial crisis just before it bottomed out.
Minus 30. Wow, and this is tech
so
bubble?
I think that's going to be interesting to watch. But I think if we get any break in inflation or break in Fed approach, and we start seeing that recover a little bit, I think that could be a positive sign. But it's going to be hard to break through right now with so much negative sentiment. So
yeah. Let me just look at tips. I just want to say, forward-looking inflation. The 3-year tips is kind of backed over 3.5%, 3.25% right now. So, which is interesting. The 5-year sort of backed off. I think that the longer term, shorter term is backed off. Longer term is readjusted. I've got the 10-year tips. Let me just go to the last 1 year. Yeah, so, okay, we had a little spike up to 3%. So we're, 10-year forward-looking is 3%, backed up to 2.8. So the expectations for tips has certainly backed off, combined with very negative consumer sentiment, as you very smartly brought up, with the first contraction of GDP. Yeah, it's looking pretty dire here, so that might be a good thing. Isn't the market sick and twisted?
I agree.
All right.
All right, man.
All right, thanks.
Good stuff. Glad we were able to do this morning, and I'm sure we'll be in touch a lot today.
Yeah, we'll be in touch, and we'll be back on our normal schedule here. I was traveling last week. It's just been absolutely bonkers, but back normal schedule, and we'll see you guys Thursday. We'll do 3:45 our normal time. Check us out at New Age Wealth. Jump on our email list. We'll send you two at most emails a week. Hopefully we think of helpful content. So